In the news, you may have seen the headlines that bond yields have been on the rise, but then you notice the value of your bond investments crashing. Stay tuned to find out why.
How do you know the bonds are worthless?
Let's take a closer look into what a bond is. A bond is effectively a loan, where the purchaser of the bond gives the issuer cash. The issuer of the bond then will pay interest until they hand back the cash they have borrowed. Although bonds in the real world can be complex, the three main properties of a bond are the amount being borrowed, the interest rate, which can be referred to as the yield, and the time frame for when the bond matures. When governments need to borrow money, they will issue bonds. In this example, each bond is for £100 with a yield or interest rate of 5%, and the bond matures in 3 years. John, an investor, decides to purchase this bond for £100. When 1 year passes, the government will pay the 5% interest, which is £5. After another year has passed, another £5 is paid. When we are in the third year, the final £5 payment is made, and the original £100 that was borrowed is given back to John. We display the cash structure for the 3-year bond. Now say John wants to sell the bond after 1 year to another investor. We can look at the remaining cash payments for the bond. As the interest rates are fixed, this bond still has an interest rate of 5%, but now is considered a 2-year bond. As 1 year has passed, John will receive his £5 payment and will look to sell the bond in the market. If investors are happy for an interest rate of 5%, they will buy the bond for £100. However, as 1 year has passed, investors may want higher rates, as they now, say, expect higher inflation. As it is a fixed bond, the payment on the bond of £5 a year cannot change. So the only way the bond can produce higher yields is for John to sell the bond for less than £100. We will show you why this is the case through an example. Say John sells the bond for £92 to another investor, called Timothy. Let's look at what the payment structure will be now over the horizon. Timothy purchased the bond for £92 from John. As John has only received £5 of interest for the £100 bond, he actually makes a total loss of £3 from his investment. After another year, Timothy receives £5 interest payment, and then after the second year, receives the last £5 payment. The government returns the £100 back they borrowed to the bondholder, which is now Timothy. Over the 2 years, the investor Timothy has made £18, which is an average of £9 each year, which is a yield of around 9.8%. This is larger than the 5% yield, or the £5 each year that John received. So you can see that as John sold the bond for a cheaper price than what he originally bought it for, the yield of the bond increased for the purchaser Timothy. The key points are, on a fixed rate bond, the interest rate paid out is not impacted by changes in the market. However, if a bondholder wants to sell the bond, the price he can sell the bond will depend on the current market yield when compared to the current fixed rate on that bond. Finally, if the interest rates in the market are higher than the current payout on the fixed rate bond, the value of the bond will decrease, so the effective interest rate is equal to the market price. Thank you for watching this video, and I hope you now have a basic understanding on why there is an inverse relationship between the bond yield and the value